Well, I think we're ready to get started for the deep dive this morning. So I want to say welcome to everybody joining us on this Monday morning. So grateful for everybody that joins every Monday as we get started with the deep dive. Today is Monday, November 29th. Just a couple of days away from December. It's hard to believe. And then the end of the year. So grateful to have you on this morning. Hope you had a good break last week with family and friends, and a happy Thanksgiving. This morning on the deep dive, we're going to talk about interest rates, give you a little bit of perspective where we're at, what experts are saying. We'll recover that, and then some questions that are coming up in the market right now around interest rates. And the KCM research team has done a phenomenal job going back historically at what's happened with interest rates when it comes to home sales, when it comes to prices, and all of that to give you the information, to be the knowledge broker, to be the expert in your market relative to what's happening in real estate. You know, for the last couple of weeks, we've been on this topic, of talking about what's coming in the winter. I talked last week about why we should see a lot of listings this winter and a lot of information indicating that. And if you didn't see that, go back and watch last week's deep dive. If you're a KCM member, you can watch that archived in the member area. If you're on Facebook, you can go back and see it there. And then the week before that, Kate talked about what's coming next year and what experts are forecasting for the real estate business in 2022. All of this is important right now. And what we cover today is important because over the next several weeks, many of us in holiday gatherings and seeing family and friends will be talking about and we'll get questions about the real estate market. And our job is to have the best advice for folks that are thinking about buying and selling, or maybe they're saying, hey, in the next couple of years, we're thinking about that. So how do we best prepare ourselves? You can't have those answers. And if you missed that, go back and watch the last couple of weeks of deep dive. But we'll get started with this interest rate update. So the deep dive for today is an interest rate update. I'm going to start right here with the most recent update from Freddie Mac. Despite the noise around the economy, inflation, monetary policy, mortgage rate volatility has been low. For the most part, 2021, mortgage rates have stayed within a 0.5 percentage points, which is a smaller range than in the past years. And oh, by the way, add to that coronavirus and everything going on in the world, the average 30-year fixed right now, 3.1% as of last week prior to Thanksgiving. I'm going to show you graphically what that looks like right now. I always, when I'm using this graphic, I start to tell the story. And if you're making a video or putting this out there, use this as perspective. Back in 2020, before the pandemic started, rates knocking on the door of 4%, the pandemic hits and we see this drop. The Fed comes in and acts. They can't control rates, only hope to influence them. And they influence the late rates very, very low for home financing, somewhere around, 2 3/4, maybe lower than that. We hit, I think, 2.65 at the low, and today we sit at 3.1% for the average 30-year fixed in this country. Still very, very good financing relative to buying a home, but the word out there, and I think most people know this, rates are going to be rising, and they're going to hear that certainly on the news, and that's going to be a lot of Fed talk. Fed's going to start to raise interest rates. Now, we know the Fed does not control mortgage rates, but they hope to influence them. And the overall forecast is that mortgage rates are going to rise. And I mentioned before, many asking, okay, what's that going to do to real estate across the country? Is that going to slow home sales? Is that going to slow appreciation? And we'll talk about that. But as you go into those gatherings that I talked about as we started the deep dive, with family and friends over the next several weeks in the holiday season, people are saying, what do you think is going to happen with interest rates? Let me give you a couple of perspectives. First, where do I think interest rates are going? I think they're going to go back to where they were. That's the simple answer. If you remember this graphic from several weeks ago in the deep dive, I used that. You go back to 2016, 2017, 2018, 2019, four, I'm going to call them normal years in our business before 2020, which was an abnormal year. We bounced around between 3.5% and call it 5% in interest rates. And where are we heading? We're heading back to that range. So certainly in those years, those were good years in the real estate business. We've had 2 phenomenal years in real estate, but I think we're heading back there. That's my first point. The second point is, what are experts saying? Well, experts are saying sometime, by the fourth quarter of next year, between 3.5% and 4%. I'm not here today to try to forecast or pin, where interest rates are going to be, but I think it's safe to say interest rates are heading back to where they are. Experts are forecasting this right here. You see the average of four forecasters: Fannie, Freddie, MBA, and NAR, and it's going to cost more to buy a home in the coming year and coming years. So that's where I mentioned, if we're talking to somebody right now that says, in the next year or two, we're thinking about buying, we want to educate them and say, okay, this is what it's looking like relative to interest rates. And if that means they want to, make a decision sooner, and that's right for them, we want to help them do that. If they say, no, I understand that, and I want to be educated, but it's not the right time for me, then we want to keep educating them. But no doubt, this is the message that as we go through the winter, as we go into next year, is going to begin to pick up steam relative to interest rates. Now, in just a minute, I'm going to talk about two of those big questions, but having this information is key. Having a graphic like this on your phone as you're talking to somebody, maybe at a holiday party or something like that, and they ask a question, say, well, let me show you what experts are forecasting for next year. It's not just my opinion. It's not just something that I'm saying. That will be tremendously helpful over the next few weeks, and I hope you use that. In every morning on the deep dive, every Monday, we want to give you an item that you can go out and make a video on, you can go out and talk about to get the message out into the market. Now, I believe as we go through the next several months, these questions that come up about interest rates, about the real estate market next year, about are we heading towards a bubble, are only going to start to pick up more steam. And the first question is, mortgage rates and how they increased. How is that going to affect home prices? There's a lot of people, and you may want to tag somebody in your office that you've talked to that says, as interest rates rise, this is what that's going to mean for home prices, or that's what this is going to mean for home sales. The KCM research team has gone back and looked at all of the historical information and said, okay, in an upward trending interest rate environment, what was the impact? So let's take a look at that real quick. First, home prices are slightly impacted by rising mortgage rates. This graphic here goes all the way back to 2000 and takes the interest rate environment there in the yellow and red bar or line, compared to appreciation in the bar graph. Now, what always stands out is the years of depreciation during the housing crisis. But what we can see is in trending interest rate environment, it hasn't obliterated the housing market. Maybe a slight impact several years. You see the first rising rate environment in 2005, still appreciation, no depreciation in that outside of the crash. The next rising rate environment's coming out of the real estate crash of 2008 and all of that. We see homes appreciated nicely, and the same in 2016 and 17. So anybody that's saying, as interest rates rise, that's going to impact appreciation, well, maybe slightly. If you go back to what we talked about several weeks back, Kate mentioned what forecasters are saying about appreciation. They're saying healthy appreciation next year, but not as much as this year. So that lines up, but nowhere near anything like depreciation as interest rates rise. And there certainly is chatter about that in our business. I'll go on further with what Mark Fleming says. He says this: house price appreciation is resistant to rising mortgage prices, primarily because most home sellers would rather withdraw from the market than sell at lower prices, a phenomenon we refer to as downside sticky. That makes a lot of sense relative to the interest rate environment. So if somebody's asking that, if that comes up, you've got the answer right there. The second question that comes back: what is the historical impact of rising interest rates on home sales? Well, what we can see is that if we go all the way back to 1989, we again have in the line here the interest rate environment as compared to home sales. We can see home sales are not impacted by rising mortgage rates. And each one, I won't go through each one of them there, but you see each one of the rising interest rate environments, and you can see home sales growing through those. And certainly the crash of 2008 is going to be the anomaly in all of these situations. And home sales dropped during that time in the rising interest rate environment of 2005 and 6, but in all other cases, home sales grew. Why is that? Because rising interest rates are a sign of an improving economy. And I certainly think as we go through next year, that's what we can expect. And as the economy improves, more people have the capacity to go out and buy a home. Now, all of this is going to be at the mercy, so to speak, of the coronavirus. There's no doubt that is the underlying theme, is the economy will take the path of what's going to happen with the coronavirus. So we're going to continue to watch all that at KCM. The KCM research team goes back and gets this information for you so that you can bring that to the clients you serve, because I think these questions are going to come up. Now, I think the important thing here is that context always matters when we're talking about all of these subjects. And I want to go back with what Mark Fleming said. He said, context matters for purchase demand. The economy is improving. Millennials are continuing to age into their prime home buying years in the large numbers. So the context remains good for the housing market. So rising interest rate environment, certainly forecasters are forecasting rising prices, and the context remains good for the housing market. Now, I want to go back to one other quote, going back to what I talked about last week. Many of you were on the deep dive last week when I said, we could see a coming wave of inventory coming this winter. Danielle Hill came out again. Listings rose for a second week in a row, with our recent survey data suggesting a growing share of homeowners and potential sellers eager to find new homes. There's reason to believe this may be the start of a welcome trend, especially as we move into the colder months. No doubt people over the last year have put off their home buying plans because of the pandemic, and we're seeing more and more people say, we want to sell a home, we want to buy a home, and I expect that to continue through the winter. And really, we have an opportunity to talk to a lot of people that we haven't seen in a long time over the coming weeks. And I'm not suggesting that we're going to turn every holiday party or church gathering into a listing appointment, but I am saying we have the opportunity to bring the truth, be the knowledge broker in some of those engagements. So I'm going to pause right here. Jess, do we have any questions?
We do. We have a few. The first one is from Nathan.
Okay.
He asked, the biggest question, the biggest objection I get is, I want to sell, but all the money I make, I have to spend on the next home.
Sure.
Is that a true way of thinking?
Well, I think that is a question that comes up. And there's, Nathan, I appreciate that question because it comes up a lot. You're right. And there's an embedded question in there, I think, that we're not asking or not acknowledging, is that if I sell today, and I'll repeat the question back, I think, is if I sell today, I'm going to have to use that money to buy an even more expensive home, is the essence of that. Okay, so that is true. But what that embedded question that I mentioned is that somehow pretends that there's going to be depreciation in the market. Now, Nathan, if you want to email me at david@keepingcurrentmatters or go into the KCM member area, you can go see what forecasters are forecasting for the next 5 years in real estate. So my response would be, there's nobody calling for depreciation, and certainly homes have appreciated over the last couple of years. There's no way to deny that or not say that's not reality. And they're forecasted to continue to appreciate, primarily because there are fewer homes on the market than there are the number of people that want to buy them. So I think it's coming back to it saying, okay, what do you expect happening in the next couple of years? And certainly homes are more expensive, but they're expected to appreciate in the coming years.
Second question is from Bill Mays.
Okay.
The historical data is great. How do you think interest rates combined with supply and demand issue affect the appreciation of homes?
Well, I can go back to so I'll repeat the question if you didn't hear it. So Bill Mays asked, what do you think interest rates are going to have as an impact on home price appreciation, right? Is that the essence of that? Okay. So I think what we can look at there is, what are experts forecasting? I can tell you, Bill, and again, you can go back into the KCM member area and grab this. The average appreciation going into next year is 5.1%. We haven't finished this year yet, obviously, and we're going to see very, very hot appreciation this year. Experts are forecasting less appreciation, not depreciation next year, but less than this year. Why is that? I think some of that is due to rising interest rates. I think some of that is due to more supply coming on the market. That being those that didn't put their home on the market in the last year. Builders building, they know this is a great time if they could just get them built and get through the supply. And all the demand challenges, I mean, not demand challenges, but supply challenges they've had. They're ready to build. So I think you're going to see that happening. And I think you're going to see some people say, if we can sell our home for this, we're going to go ahead and sell. So we're likely to see more supply on the market, which will have an impact on price. Price is always going to be governed by supply and demand. And I don't know of a market right now that says, we have plenty of supply in our market, we just don't have enough buyers. Just about every market in this country has more buyers than they have active listings.
And our last question, it also has to deal with objections. This is from Christopher. He said, one objection I get with first-time buyers is that the market is too hot.
Sure.
Calm down.
Sure. And I think I would go back to the first answer, Christopher. So the question was, first-time home buyer that says, gosh, the market is just too hot. I would go back in the KCM member area and I would show them this. Now, I always want to say this. We don't want to convince somebody to do something that they don't want to do. What we want to do is we want to educate them. And what I would want to educate people on is the average growth in equity over the next 5 years for the average home purchased in this country. And I can tell you by memory, it's about $111,000 in equity that somebody stands to earn. So no doubt home prices have appreciated. No doubt people feel that shock. And the appreciation that's forecasted for the next 5 years is very real. So Christopher, in that question, I would put that information in front of them and say, let's talk about this. Yes, home prices have appreciated, but here over the next 5 years, here's what you stand to gain in that appreciation as you go forward. And oh, by the way, for a first-time home buyer, it has come out that in every major market in this country, top 50 markets, even in San Francisco and the markets that we know that are outliers, when you add in equity, it makes more sense to buy than to rent in today's market. So I think showing them those facts about home price appreciation will help be able to educate them what's happening with real estate. Any other questions? All right. Well, as always, thank you for joining the deep dive. We're grateful for your support of KCM, and we'll see you back here next Monday. Take care.